Hello there and welcome to FX Street Currencies in Play, brought to you by Royal Financial Trading. I'm joined by Mr. Mark Oswald, who is a strategist at ADM Investor Services. How are you today, Mark?
I'm very well, thank you.
Okay, well, let's have a look at the headlines of the day. Plenty going on in the world, in Hamburg and beyond, but the euro dollar retakes 114 on soft dollar and hawkish ECB. I believe that you're slightly in slight disagreement on the stance of the ECB at the moment.
Yes, I wouldn't call them necessarily hawkish. I'd say they were being slightly less accommodative, but the idea that they're going to be raising rates anytime soon is frankly preposterous. I mean, there's chatter that they may go for a taper exercise from January down to 40 billion. That's hardly something we should be running scared of. I think what really is powering this higher, though, is the narrowing in the 10-year US euro yield spread. And we've seen Germany, particularly the 10-year Bund yield yesterday, was just jumping higher and higher, breaking key levels. We're up to 0.56, which in the greater scheme of things is very unattractive. But it's not so long ago, barely 2 weeks ago, that we were down at 0.2. So for those who want to be overly dramatic, you could say, well, the 10-year Bund yield has tripled in the past 2 weeks. And that's definitely playing into that equation at the moment, though I'm not sure that we're not in a situation now where there's been a lot of euro longs accumulated, and so you're now starting to accumulate some risks on the downside if the ECB doesn't actually start to deliver.
Okay, let's have a look at the chart just over the last 24 hours, 50-minute chart if we can. See that surge even before the ECB revelations around lunchtime, so just went up and stayed up and is just treading water now. No sign of any weakness.
Yes, I mean, to me, that's a chart which suggests that we're gradually losing momentum on this up move. It's starting to look a little bit tired. So we'll see. We really need to have a weak US set of labour data today, I think, to really drive the euro higher, or, on the other hand, to see 10-year Bund yields rise even more.
Okay, and the US dollar lower on poor June ADP report, and dollar index below 96. Otherwise, dollar yen looking quite sprightly this morning, above 113, above 113.50 off the rising US 10-year. And just look at the chart there again. This was we had the move ahead of the obviously the big data today, and obviously now we're just treading water. But there was quite a surge overnight.
Yes, quite a surge overnight. That was initially powered by that rise in the US 10-year yield, though then the Japanese the Japanese central bank was trying to stop the JGB yields rising at the same rate, and that's basically what sustained it, as the Bank of Japan basically came in to cap 10-year yields in Japan. So you've got a widening differential there, and that makes the carry trade for Japanese investors that much more into dollars, that much more attractive.
Right, and then finally we've got the June non-farm payrolls and the G20 meeting between Trump and Putin, as if that would be a currency moving situation. Unless it was a punch up, I don't think that would really.
Yes, I don't think that specifically would be the Trump-Putin meeting is specifically going to be something which upsets the market. But there are other aspects, particularly on free trade, which could.
Okay, let's go on to the trade of the day. Well, it's a mini trade here. Fundamentals have been supportive of the euro since the beginning of 2017. Inflation in the euro area is around 1.3%, was around 2% at the beginning of the year. Trading technicals have been painting a bullish picture for the euro. Stochastic, RSI, 30-day and 100-day moving averages have been flashing an unmistakable buy signal. Buy euro at 114.30, profit target at 114.50, so 20 pips there. Stop loss at 114.15 once you're in. Risk-reward ratio 1.33. Presumably you're saying, as you suggested earlier on, that you think that that's about it for the euro on the upside.
Yes, I mean, I think that's about it. I mean, what's really driven the euro higher is the fact that everyone was basically looking for the growth in the eurozone to be, as ever, pretty weak, and it's turned up much stronger. In fact, the eurozone of the G7 bloc is actually the best performing thing. But as I say, I think we're now at that point where you always have to look at positioning. Is everyone already long of the euro?
Okay, let's see what they are long or short of with the trading positions. 65% long, 35% short. This is an amalgamation of everyone, so retail, institutional, banks, etc. So smart, dumb, and people in the middle as well. I'm not saying which one is which. So there we are. So basically long of the euro and the pound, 50-50 on the yen, a bit short of the dollar Swiss, very short of dollar Canadian, which I suppose we're just below 129, or about below 130 at the moment. So that's fallen like a stone recently, hasn't it?
Yes, and that one really needs a delivery move. Next week, the Bank of Canada has its rate meeting. Basically, as long as the Labour data today are reasonably firm, everyone's expecting a 25 basis point rate hike from the Bank of Canada. If they weren't to deliver, that could reverse very, very sharply. I'm not sure that actually, even if they do deliver, it may not be a case of buy the rumour and sell the fact.
The 130 looks like the ceiling at the moment, which is
it should be
amazing.
It should be, unless they don't hike rates.
Okay, and then 50-50 on the Aussie. That seems to be sort of marooned around the 76 level, 75, 75. Well, 76 exactly at the moment. Been down to 75, 75, but a mini range. I mean, it's amazing that it's quite so dull.
Yes, and I think that's probably because people at the moment are looking at other pairs, particularly things like euro-yen, which has been choppy, dollar Canadian, and so it's able to sort of go off into stage left and have a quiet period. But for the time, I think the moment you start to see some more interesting numbers coming out of Australia, perhaps you'll get a bit more of a revival and more of a desire to actually seek some positions. The real problematic for the Aussie dollar is basically you're getting to the point where they're almost at rate parity with the US.
Right. Okay.
So the carry isn't that attractive.
Yeah. Okay, and then finally, long of euro sterling, which is the opposite to the retail people on their own. And that's up at 88.36. So I think it's almost bearing out the idea that the eurozone is on fire.
Well, it certainly seems to be. Yes. Yeah.
So political stability and economic growth.
Yes,
and,
not the instability that everyone was predicting, and not the weak growth that everyone was predicting. The thing which is obviously missing from the equation is that the inflation numbers still aren't really anything which cracks up or puts any pressure on the ECB to start tapering more rapidly, or even start to consider when it might need to hike rates.
And over here, just a mess of uncertainty, bad trade figures, bad this, bad that.
Yes, and I think that the real risk is after the bad numbers that we had this morning, we get the labour data next week, average hourly earnings, absolutely critical. If that doesn't really show any sign of a pickup from the 2.1 that we had last time, which is very low, and the week after we have the inflation numbers, and if that stays below 3, then this idea that the Bank of England may be having a robust discussion about hiking rates, but probably won't deliver in August, is probably going to turn out to be the truth, in which case the downside for sterling, both against the euro and the dollar, is quite big.
I mean, so do you think the market's just not factoring that in at all?
Well,
believe the bait of we could be starting to raise interest rates.
Well, yes, exactly. They're taking forward guidance literally. This may be one of those occasions where they do need to be reminded that Mr. Carney is their unreliable boyfriend.
Yeah, and also if people actually listen to what he said, he was basically saying, I'm only going to raise rates when hell freezes over. So there's no Brexit uncertainty, there's more investment into the economy, people get double their wages, blah, 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 which is not things which is not going to happen at all.
Yes, exactly. I mean, I think the thing here is they can have a very robust discussion about it to show that they're doing their job. That is their job, to have a discussion. But that doesn't necessarily mean they're going to deliver. And if you actually look at the history of the Bank of England over the past 5 to 6 years, they've quite often had occasions where they've said, I think we may be on the cusp of a turn in trend. And at the end of the day, you get a couple of people voting for a hike, and then they all move back to the sidelines, and policy is held unchanged.
Let's have a look at the calendar, where labour force participation rate, unemployment rate, non-farm payrolls, and unemployment rate, presumably those are GMT figures.
Yes,
for eagle-eyed people there.
Yes.
You don't want to get there too early, but well, obviously we'll see how the non-farm payrolls go later today. But that's it for FX Street. Currencies in play. brought to you by Royal Financial Trading and starring Mark Aspel, strategist at ADM Investor Services.